Since the global financial crisis, which hit China as hard as other economies, although it did maintain robust growth consequently, but it certainly brought down the phenomenal rates that had been experienced hitherto. Since then, there's been a transition to more of a consumption and service-oriented economy. There's a lot of debate about what actually is happening in China in terms of its macroeconomy. Is it the rebalancing that explains it all? Is it an overhang of debt as a consequence of the large stimulus that was undertaken in response to the global financial crisis? Or is it in fact a stalling on economic reform? There were major reforms undertaken through the 80s and 90s, and there's been some stalling in reform since the turn of the century. So we see, just switching now to the impact on Australia, just as China is restructuring, it has implications for Australia restructuring, because we had become far more heavily dependent on China. So we see that over recent decades, China has greatly outpaced our own growth. And through this time, China became Australia's #1 trading partner. So we now have a trade share, two-way trade with China is around 23% of GDP. #1 trading partner ahead of Japan, the United States. And interestingly, if you look at all of the others in that list, with the exception of United Kingdom at 7 and Germany at 10, they're all APEC economies. So we are inescapably tied to our own region in terms of our trade and investment flows. So here we see the spike in the trade with China occurred at the time of the mining boom, at the beginning of the mining boom. The purple line there shows just how much trade with China increased over that period relative to our other major trading partners of Japan and United States. The other major development has been the China Free Trade Agreement. I'll say a little bit more about that in a minute. But there we have it, 30% of Australia's exports to China, 16% of imports. So there's an imbalance there. We're exporting a lot more than we're importing. But the bulk of those exports are mineral commodities, and it was that surge in demand that underpinned the mining boom. So we've seen with the tapering of growth, the slowdown in China, that commodity prices have also come down as well. Commodity prices are normalising. We look at this chart here, an index of commodity prices, Australia's commodity prices, and you can see just how great that surge in prices was from the mid-2000s. That was the start of the mining boom. And the little dip there you see is the global financial crisis, a stalling, a setback there, but then another rise, peaking in 2011, and been a big slide since then. But a little bit of an upturn right at the end there, and it seems that commodity prices have now stabilised somewhat. And it's also interesting to note that we have commodity prices still significantly above levels pre-mining boom. Yeah. So the China-Australia Free Trade Agreement, I'm sure others will have much to say about this. It's very convenient for Australia because as China's economy is restructuring, as I said before, it means that our economy must also restructure in part as a consequence. And with China moving to services, and given Australia's services intensity in the economy, it's over 70% of GDP, there's potential for great gains there. So the Free Trade Agreement has removed tariffs on a whole host of items, agricultural, energy commodities, processed foods, pharmaceutical and car engines, and has promoted increased trade in services, okay, especially tourism, health services and financial services. Health services in particular is noteworthy given that China's population is ageing, and there's now provision for Australian enterprises to set up in that sphere in China. So just how great a boon that will be to Australia through the services trade remains to be seen. It depends really on two critical factors as far as I can see. One is whether China can sustain its relatively strong growth under the weight of the problems that it's experiencing now. And secondly, whether Australia can prevent further deterioration in our competitiveness. Australia's competitiveness has been on the slide for a decade. We're outside the top 20 in terms of the World Economic Forum measure. So that will be central to just how well we do in terms of our trade relations with China. So with that introduction, I'd now like to pass it over to Clinton Dines, who can give us his take on where we're going. Thank you.
Okay. That's on, right? Yeah, okay, good. Tony's covered, I think, a lot of the ground there in terms of providing a framework by which we might think of it and a bit of a history of what's gone on. I think a lot of this conversation really depends a lot on the prism through which you view China, and that prism has a lot to do with what you choose, what you're willing to believe. There is, clearly perspectives on China which are bearish, and that seems to be the dominant, narrative at the moment. and it has ever been a very strong narrative in terms of Western world perspectives with respect to China. And so I think one of the important things on any discussion in China is to have a look at that prism, examine your own prism by which you view China, and look at the things that attract you in terms of what you like to believe about what's going on in China. The big conversation, obviously, currently is about, levels of indebtedness in China, and there's an extent to which we, of course, are concerned about that, and we project that from our own situation in the Western world, where we have very, very high levels of debt across our societies, governments, corporates, and households. We have very low growth. We have, relatively impotent central banking responses, policy responses from governments, etc. And that tends to make us rather concerned about the whole planet. And when you've got the largest single vortex of economic activity on the planet and growth on the planet being China, that tends to attract a lot of attention. China is, still growing quite strongly. And, as I reflected on what I might talk about today, I went back and had a look at some of the work that we were doing at BHP on the macroeconomic side of things 12, 13 years ago. And looking at those charts and those curves, China is right on the money as to where we thought they would be with respect to that GDP growth number that everybody looks at. And at the time, if you look at World Bank outlooks and IMF outlooks and OECD outlooks and everything about China, everyone kind of had China's growth going from low double digits curving down by 2015, 2016 to somewhere around 6% and a bit. We're right in the zone of what was projected to happen way back then. It should not be a surprise, but it seems to be. And it's not so much about anything happening, any sudden changes in the Chinese economy. It's more or less the law of large numbers. If you have the world's second largest economy and something like 11 or $12 trillion of economic activity, to keep rattling along at 11% growth would be damn irresponsible. And it's hard to suggest that with what the Chinese government has achieved in terms of the macroeconomic policy making, their developmental decision making over the last several decades, that they are all that irresponsible. So I think, again, much of this depends on the prism through which we want to have a look at it. The other side to look at is just the usual things that you would look at when you're thinking about an economy. China has a very strong balance of payments position. In contrast to many Western world governments, they run a very modest fiscal deficit. They still have a high savings rate. When we talk about debt in China, the dynamics of Chinese debt is very different to the debt that we would look at in the Western world. And that's important. It's important that you're aware that when you look at an economy like China, are you looking at it through the prism of the way we would look at the Australian economy, or are you looking at it through the prism of the way you should look at a developing world economy? And they're very different, developing. It's worth remembering. You have an economy where most of the debt is domestic. China punched through the Asian financial crisis very strongly on the basis of not having exposure to short-term foreign debt. Most of the debt in China is domestic. The other characteristic of debt in China is that it's largely contained within the government or government-related entities. If you look where corporate debt's a very big chunk of what goes on in China. That debt is, contained within a lot of government, various levels of government, but government-owned entities. So it's important to, I think, define this. Household debt in China is relatively modest. And private sector corporate debt in China is relatively modest. Government debt in China is relatively modest by any standards. If you cobble together all of the government debt plus corporate, state-owned corporate, and put it all together, it becomes a significant number. But it's certainly not a number that is out of line with all of the other comparable major economies in the world. So I think the other characteristics that one needs to think about is that a lot of debt in China gets counted as debt or gets counted as non-performing debt on the basis of being somewhat misaligned. There's quite a lot of local government debt in China where they borrow for 3 years and invest in a 30-year project. Much of what you see has been happening last year and this year in restructuring debt in China has a lot to do with alignment. And once you get a 30-year debt line all lined up against a 30-year project, a lot of things that used to be called non-performing loans cease to be. Don't let me diminish the challenge. Don't really diminish the fact that there's been a lot of profligate investment in China. There's a lot of people have done some very dumb things. And there's a lot of stuff that's been invested in that really shouldn't be. And one of the defining characteristics of China's current economic situation is excessive capacity and a lot of inventory sitting around doing nothing. But again, excess capacity and inventory, be it product inventory or be it real estate inventory, is something that we are utterly neurotic about when we look at it through the prism of a Western world developed economy. If you look at our economies, the psychology of our economies is economies that have had very low growth for a very long time, pretty much since the 1970s and inflation and the oil shocks. And in that situation, the greatest single sin you can commit as a government or as a corporation is to build excess capacity or have excess inventory. When you're a developing country going very, very fast, you actually have to build inventory and build capacity out in front of demand. It takes a few years to get that momentum up. That's precisely what's happened in China. And once, of course, your headline growth rates come off a little bit, you end up with quite a bit of inventory. But still, a big economy growing at 6% with a lot of people still joining the affluence club every year has an amazing capacity to absorb inventory much faster than we can. So it's worth, again, having that prism through which to view some of this stuff. And I remind you that China is still growing strongly, and it's unlikely that China is going to suddenly crash into negative growth or very, very low rates of growth. The most bearish of assessments that I've seen aren't suggesting that China is going to fall off a cliff in the near future. I think the other thing we need to remember is that while the state of China's economy is very, very topical for us, for countries like Australia who are influenced by China in a significant way, and the rest of the world who trade with China significantly, the state of China's economy is, of course, highly topical in Beijing. And it's very easy for us, again, to underestimate the capacity of the Chinese government, not only to understand their problems, but to develop effective responses. They've got a pretty good track record. there was a lot of missteps that I observed firsthand in the 80s and 90s and through the 2000s even, and in recent times we've seen missteps in terms of handling certain situations in the economy or commercial situations. But by and large, their handling of the economy has been good, has been successful, and successive generations of the bureaucracy and government are increasingly more sophisticated in how they go about it. They do tend to go gradually, they tend to go slowly, and again, there's a degree of responsibility inherent in being in charge of the second largest economy in the world and a fifth of humanity. We tend to, most prescription to the Chinese government about what they should do tends to be of the short, sharp shock type. And the last thing the Chinese government is ever going to do is short, sharp shock. You can't do that without economic or social dislocation. And if there's one thing the Chinese government is all about, it's all about stability. So I would expect to see them continue on in that vein and squeeze things gradually rather than make large dramatic lurches in one direction or another. In terms of implications for Australia, the extent to which China's slowdown has impacted Australia is one dimension. But of course, the way markets work is that when you have a significant new vortex of demand, the supply side responds. So with respect to China and energy and raw materials commodities, which is most impactful on Australia, as China's demand developed and developed very, very rapidly, we responded. But the scale of China as a new source of demand was beyond what we had previously imagined. So it took quite a long time for us to respond adequately. It took a long time for the global commodities and energy space to respond adequately. But inevitably it happens. In every market, whenever high demand and high prices happens, you get a supply side response, and sooner or later, supply comes in. And that's what's happened. And when you have enough supply, the price goes down. It's very basic, and that's essentially what's happened. So what's happened to our exports is as much about there being plenty of supply as it is about China slowing. China was always going to slow, as I said when I started. China was always going to be at 6.5% in 2016. It was never going to be another way. And we knew that 10 years ago. So certainly I know at BHP, when we were putting in cases to the board for approval for a couple of $2 billion to build a new project, we certainly didn't have China growing at 10% in 2016 in the economic case that we were making. We also didn't have $200 iron ore prices in those cases, which is why BHP and Rio Tinto are still going to make plenty of money. Now, to underpin that assertion also, China may have, the headline rates have slowed down and the prices have come off, but China continues to buy a lot of these commodities. Iron ore exports from Port Hedland in Western Australia went up 4% last month, and we're up net this year. Same for a lot of commodities. China is still importing legendary volumes of these commodities, and as Tony pointed out, at historically high prices. The price of iron ore is over $50. I tell young blokes in the commodities industry these days that I spent 2/3 of my career at BHP with the price of iron ore below $25. And they're complaining about $50. You know? And the same applies across most commodities. So I think, again, the prism through which we have a look at this is fairly important. And the implications for Australia need to be kept in perspective. There's nothing terribly unpredictable about what has occurred with respect to China. China is, a phenomenal developmental story. It's a very important developmental story for humanity. There's a lot of people in China who used to be hungry who aren't. There's a lot of people in China who used to be poor who aren't now. And that's continuing. So it's quite a good story. there's a lot of dimensions about what's going on there that we might not like, and we could quite easily critique. And there's quite a lot of things to be concerned about if the Chinese government doesn't continue their track record of astute economic policy making and developmental management. Then, there's a problem not just for Australia, but for China and the whole world. But I think I'd refer to it, when I look at it, I can become very, very depressed if I just read the bearish case on China all the time. So it's worth having a look at how you think about it and the dimensions by which you look at it and shifting that prism a little bit. And I become a little less depressed. I'm concerned, but not depressed. So let me leave it there, and I'll leave the practicing economists to actually tell you, some of the other issues.
Thanks very much, Clinton. James.
Can I get the PowerPoint?
You just
This is here.
here we go. Yeah, great.
Hello, everyone. First of all, thank you very much for the invitation to be here. I have the misfortune of living and working in Sydney, but I'm very much a proud Queenslander, so it's great to be back in Brisbane, so thank you for the invitation. I'm at the Australia-China Relations Institute. Our institute is a think tank that is devoted to the Australia-China relationship, to illuminating it, so this topic is very much something that we have an interest in. I thought I'd spend my 15 minutes in breaking down this question we've got for us today: how serious is China's slowdown, implications for the Australian economy, and some of my thoughts on China's economic outlook going forward. I thought I'd spend about 5 minutes on each of these. Let me give you the punchlines first, so we get those out of the road. How serious is China's slowdown? Not very serious at all. I'm very comfortable with it, and I'll explain why, mainly for reasons that Clinton has already actually touched on. What's the implications for Australia? Pretty darn good, and I'll explain to you why I am fundamentally positive about the Australia-China economic relationship. And the future, I'm not very depressed either. I think it's travelling along quite nicely. So if you have to classify China economists into bulls and bears, Clinton is absolutely right. The bears are certainly the most popular in the press, but if you've got to put me in one or the other camp, I'm not in one or the other camp, but if I was, call me a China bull. And I'll explain to you why. The top graph is the graph that you'll always see. China's growth rate slowing down in percentage terms, and the favourite headline, of course, is that it's now growing at the slowest pace in 25 years. That doesn't actually mean a lot, because the bottom graph tells you what's happening in terms of new purchasing power being added to the Chinese economy. So this is Clinton's law of large numbers. Of course, if the economy is double the size it was 8 years ago, even if it's growing at a slower pace in percentage terms, it's actually going to be adding more purchasing power. And in fact, that's exactly what's happening. So if you want to know, it's pretty hard to reconcile, isn't it? The Chinese economy is apparently collapsing, slowing down in growth, and yet we know that Chinese tourist numbers to Australia over the last 12 months have been up 23%. Right? There's 20% more Chinese students studying here than last year. Well, that's pretty hard to reconcile with an economy that is apparently collapsing. Well, there's the explanation. Right? The new purchasing power being added to China's economy hasn't slowed down at all. So how serious is China's slowdown? That's why I say not particularly serious at all, if you ask me. Of course, there has been a change in the pattern of growth. No arguments there. So the top graph there shows the rise of China's services sector as a percentage of GDP, where the line that's trending down is the industry share of GDP. So that's a secondary sector. Remembering, of course, that the services sector still has a very, very long way to go. It's sitting at 51% of GDP now. In the US, it is 80% of GDP. So that's, I guess, one of the reasons why I'm fundamentally quite optimistic about China's prospects, because it's still got a long way to go from some fairly standard sources. The bottom two graphs show changes in the pattern of demand in China. So retail sales, consumption type indexes have proven to be quite stable, whereas what's slowed down has been fixed asset investment. So it's a reallocation of demand away from investment towards consumption, and we'll see some of the impacts that has on Australia in just a minute. So as China slowed down and this pattern of growth started changing, this new normal growth, as they call it in China, what's the impact on the Australian economy? well, I think a few years ago, the impact was not expected to be very, very good at all. I've just put up a few screen grabs in front of you. Some work by academic economists, some work by policy advisors, some work by journalists, all talking about how China's new normal was going to devastate the Australian economy because all we sold to China was iron ore. And so if their growth rate slowed and moved towards consumption, then we'd suddenly be in trouble, right? That was the story. And so I guess what I want to talk about next is, has that happened? And the answer is most certainly not. Now, the top graph here is simply our total exports to China, okay? So this is mining goods, non-mining goods and services. You'll notice that the total value has fallen since 2013, although I would add that fall in value is quite modest. Still up massively compared with 5 years ago, all right? So let's get that in a bit of context. Now, if you want to know what's been happening over the last couple of years that's dragged the total value down, take a look at the next two graphs. So the bottom left breaks Australia's goods exports to China into mining goods and non-mining goods. The value of mining goods has fallen for one reason, and Clinton is absolutely right, because prices have fallen. The big reason prices have fallen is not because China doesn't want our iron ore. China demanded 6.5% more of our iron ore over the last 12 months. That's not bad when it's already coming off a massive base. China demanded 85% more of our LNG over the last 12 months. So it's not just, even in the resources space, it's not just about iron ore. So the prices have fallen, that's what's dragged down value. Everything else is up, right? Non-mining goods, up, okay? Think of premium food and beverages, up. Wine sales over the last 12 months, up 47%, right? Chinese people are thoroughly enjoying Australian red wine at this very moment. What's happening to services? Well, that's on the right-hand side. In 2014, China was already by far the largest consumer of our services. Last year, it went up by 20%. Okay, what's happened this year? Chinese tourism numbers up 23%. The rest, that's double the pace of the rest of the world. Okay, Chinese student numbers already by far. Anyone who works in a university gets quite nervous about how exposed we are to the Chinese market. Well, guess what? It's up 23% as well. Students from other countries are growing at less than half that pace. Right? This is not a depressing story at all. Now, last 5 minutes, the outlook for China's economy. So far so good, but is it about to fall into a heap? I'll break that into a short and long run story. Is it going to fall in a heap next 6 months? There is absolutely nothing that I can see in standard economic data, in standard economic indicators that suggests that it is, right? If you want forward-looking indicators, you look at consumer confidence indexes and purchasing managers index on the supply side, on the production side. Well, this top graph, this is produced by Westpac, by the way. So you don't have to worry about the quality of official data here. I mean, that's another thing. Yes, China says it's growing at 6.8%, but we all know that's not true. I don't take that line, by the way. Well, just look at what Westpac's doing. Surely we trust Westpac. There's a consumer confidence index. Do we? Oh, well, maybe not. So maybe I've been living in the Sydney CBD for too long. I'll take that back. Maybe I should have used official consumer confidence indexes here. Now that line in the top graph may look a bit weird. We're below the average. That's the long run average. You'll see the long run average is at 120. The dividing line between optimists and pessimists is 100. That's not even shown on the graph, okay, because we're so far above it. You'll also note over the last 3 years, consumer confidence hasn't dived. Now, you know, some people in Australia and America think they know China well. Well, I can tell you they don't know it better than someone living and working in the Chinese economy every day. Right? The Chinese consumers, right? They are still confident. So frankly, as long as the average Chinese consumer, and this is across the country, by the way, Westpac break this down into all the regions of China, there's no collapse in Chinese consumer confidence. Remember, and also that most of Chinese growth now is driven by consumption. So I'm feeling pretty comfortable over the next 6 months, 12 months. The bottom graph there is a mix of purchasing managers index. So this is the confidence of businesses. There's nothing wrong. Most of those are sitting just above 50, which above 50, it's growth month on month. So there's no collapse there on the supply side either. Now, longer run. The OECD says it's going to be magnificent. They suggest that the rise of China's middle class is going to continue by 2030. Between 2009 and 2030, 850 million more Chinese, okay? Not in total, 850 million more Chinese are going to join the middle class, right? They are the ones that we're seeing boosting our student numbers. They're the ones we're seeing in our tourist numbers. They're the ones buying our wine, right? And we're going to get 850 million more of them. I find it very, very difficult to be depressed when that's the outlook, not by the Chinese government. This is coming from the OECD. Now, do we believe them? The big question in China for me is not the debt issue is something I'm concerned about, but as long as China is able to move up the value chain, that is move from producing low value-added goods to higher value-added goods, then I don't think we really need to worry. So is China capable of moving up the value chain and producing those higher value-added goods? There's a lot of nervousness about that. People think, well, you know, China's a one-party political system. Does it have the flexibility? Does it have the creativity? Can it handle that jump? Or will it get stuck in this so-called middle-income trap? Well, once again, sorry to sound like a broken record, but I'm fairly positive. And I'll tell you why. It's already done it. Any of you who have been to China have probably been to a place called Shenzhen, right, which is just across the border from Hong Kong. Now, that's well and truly part of mainland China. Per capita incomes in Shenzhen, in some parts of Shenzhen, are actually higher than they are in Korea and Hong Kong. Shenzhen produces a whole range of very, very high-tech, high value-added goods. Now, I concede, right, there is a very, very big difference between Shenzhen and, say, some western province like Gansu, right? I concede that. But what it does tell me is that the institutions at play inside China can do innovation. And Silicon Valley is not the US either, right? So I think the fact that we have these places, it's not just Shenzhen, by the way, there's tech hubs around China, they at least show that it can be done. So look, given that background, that's why fundamentally I remain quite optimistic about China's economic future, and I remain very optimistic about the Australia-China economic relationship. Thanks.
Thanks very much, James. Michael.
So I need to control something. It should be here, but it's not. Oh. So where do we go? Just goes down. Oh. Just me or? Okay. I'd like to go into just a couple of things that James touched on, which are in my presentation, and how some of those things have been, some of the data has been misinterpreted in Australia and is mispresented by the Australian media. And that mispresentation by the Australian media generates an impression that there is something wrong with the Chinese economy, although there is not. And I'll try and show in detail some comparisons on one of the sections of the Purchasing Managers Index relative to other data in the Chinese economy. I went to a presentation in San Francisco earlier in the year by the chief economist of the OECD, Catherine Mann. And in part of the presentation, she was talking about the Chinese economy. And she said that there used to be 80 different economists who participated in the Bloomberg survey on China. But now, because the Chinese economy, Chinese GDP is so difficult to forecast, there are now only 24 economists who participate in the Bloomberg survey on China. So I sat and I thought, well, there's 23 people who know what they're doing and me. But the advantage of participating in the survey is that you get to know the data, and you begin to get a feel for how the economy responds, and in particular how it responds in response to actions by the People's Bank of the Central Bank, the People's Bank of China, the PBOC. Through this year, people have been expecting a soft landing in the Chinese economy. Turns out the soft landing actually happened in the final quarter of last year, with growth for the final quarter of 1.6%. Now, our forecast within the Bloomberg survey is that growth will continue at that rate through this year, and it has been. And if you multiply 1.6% by 4, you'll get growth for the full year of 6.4%, which is our target for the year, and that seems to be happening. Why that's happening is because growth in China has been supported by an easy monetary policy, which is run by the PBOC, the People's Bank of China, and it's been run consistently since the beginning of last year. The People's Bank of China, like most central banks in major countries, is whether or not it says so, is an inflation targeting bank. It has an official target of inflation of around 3%, but it's actually achieved an average inflation rate this century of 2.2%. So what you find is that when inflation falls below that level of 2.2%, the People's Bank of China will aggressively begin to ease monetary policy. And it has been doing that in terms of cuts in the required reserve ratio, the ratio of assets that central banks have to hold with the Reserve Bank, and cuts in interest rates, and it's been doing that through last year, and it continues to do that. And that has generated a recovery in construction activity, and that's what's generated the floor in activity in the Chinese economy. Now, how long can this be expected to go on? Well, I said that the People's Bank of China was an inflation targeting central bank, and if you look at the inflation rate, both last year and this year and next year, it's below that average level that they've achieved at 2.2%. So we think that the People's Bank of China will continue to support this expansive monetary policy through to the end of 2017, and that will generate continuous expansion really in the Chinese economy until 2018. So why is it that people believe that there is something rotten in the Chinese economy or the Chinese economy in contraction? Well, it has a lot to do with what they read in Australian newspapers. So I take from the pages of the Australian publication of Record, the Australian newspaper, the following article published on the 1st of February. And it's about the Purchasing Managers Index, which was on one of James' slides, and I've got several slides looking at the issue of the Purchasing Managers Index and what they mean in detail. So what it said was that China's official manufacturing Purchasing Managers Index, a gauge of factory activity, fell to 49.4 in January from 49.7 a month ago, adding to the signs of continued sluggishness in the world's second largest economy. The reading released by the National Bureau of Statistics on Monday marks the 6th straight month of contraction. I'll repeat that, contraction in the measure of manufacturing activity. A PMI reading above 50 indicates an expansion in manufacturing activity, while below 50 points to a contraction. The January PMI missed the median forecast, 49.6 of Wall Street's polls of 11 economists. Okay, so there's more detail about it. But what you've learned from that is the official statement by the newspaper of Record in Australia that a Chinese PMI below 50 means there is contraction in China. Everybody agreed on that? I think that the ordinary reading of the words can't mean anything else. Now, what you see, if we look at these PMIs, we know, and we've been told that China is moving from manufacturing towards services. And so if we look at the non-manufacturing PMI, it's higher than the manufacturing PMI, but we can see they've both been going down, and you can see the manufacturing PMI has fallen at exactly the time that the Australian was talking about, below that magic level of 50. That means it must be in contraction. Now, let's compare those levels of those PMIs to a measure of economic activity, let's say GDP. If it's 50 on the manufacturing PMI. What does it mean in terms of Chinese GDP in that data going back to the beginning of the decade? Well, this is what is called a scattergram. And we put a line through the scattergram, and on the bottom you've got the index. So that's the Chinese manufacturing index, and it goes from 48 to 57. And if you read up from 50 and you look up to the line, and then you go a lot across to the left, what it tells you is that an index of 50 on the Chinese manufacturing PMI is consistent with a growth rate, not in contraction, not a contraction of the Chinese economy, but a growth rate of 7.5% GDP. Happy the country where 7.5 GDP growth is contraction. But I have seen this same statement published in the New York Times or the Financial Times of London. How did it come about? It came about because of the actions of an official who probably doesn't want to reveal his name, who worked in the National Bureau of Statistics a generation ago. And he had the job, so PMI measures, usually, most of them that are prepared and published on a monthly basis are published about Europe. And the biggest organisation that publishes them is called Market. And it's absolutely the case that in the European circumstance where they are originally calibrated for, GDP was, if you look at these charts, you can look at it on the Market website, is about 50, where growth in GDP is about 0. So they're calibrated for Europe. But the poor guy, whoever he is, in the National Bureau of Statistics, who a generation ago was faced with the problem of publishing these PMIs for China, was in a situation where the Chinese economy was growing at 7.5%, sorry, going at 9.5%, and the lowest growth rate that China had experienced in the previous 10 years was 7% growth rate. So he came to the rather logical position as a statistician that he should show 0 with 7% because it's never been lower than that. And so he did, and he published the data based on that scale, because otherwise if you hadn't done it, the variation would have been too small to read and it would have meant nothing. And it continues to be published in the form of this long departed statistician ever since. So we arrive at this situation where the Chinese PMI of 50, which actually shows the growth is 7.5%, is published in the Financial Times, the Australian and the New York Times as 0 growth. Isn't that interesting? Isn't it interesting how complete misinformation can be spread widely by your local media? Somebody else on the panel wanted to say that, but I just got to say it because it's fun. And here's the measure of the non-manufacturing PMI. It's never been below 50, but it's around about 54 is equal to 7.5% growth in the economy. Something else I'd like to say about China and how it's been affecting Australia and how this has changed, and this is from a paper that's published by the New York Fed in the last month, and that is how China is moving into the world capital market. And this is because of the negotiation that China has done to be part of the international measure of reserve currencies that is published by the International Monetary Fund, the special drawing right. And in order to do that, China has agreed, at the behest of the IMF, to open up and liberalise its capital market so that the RMB could be more of a responsive exchange rate in the same way as the other components of the SDR, sterling, the euro, and the yen, and the yen are. So as a result of that, what we see in the first slide is that the response of China to the financial crisis was an enormous increase in domestic investment, which was supported by a high level of domestic savings. But now domestic in China is slowly coming down from that peak. As it's come down, but really because of this liberalisation of capital flows which are associated with which follow the negotiation between the Chinese government and the International Monetary Fund, you have seen a dramatic increase in net lending, capital outflows from China. That's no bad thing. That just means that China has become, after investing in itself, is becoming part of the world capital market and is an important source of capital for the whole world, but especially in our case, Australia. Now, what's really interesting when you look at these capital flows is they've been masked by falls in international reserves held by the central bank. So in net terms, the net lending has been 331 billion last year, but the actual level of private capital outflow is almost twice that, 673 billion, and there's been a 342 billion rundown by the People's Bank of China and the International Foreign Reserves. So it was being reported last year, again with PMIs showing that the Chinese economy was in contraction. It was reported last year that there was this enormous capital outflow from China because the Chinese was because of panic about the Chinese economy, and the evidence of this was that there was a slump in Chinese international reserves. But really, what was happening is that China was just becoming part of the world capital market and investing in places like the United States and Australia. And that's the end of my comment. Thank you.